Hey everybody, welcome to this free edition of our Trader Use Group, a weekly roundup. This is for the trading weekend in October 23rd, 2020. I'm Preston Brent. Thanks for tuning in. Remember guys, don't be a rat brain trader. You want to be the red striped zebra. You want to stand out from the herd. This week's theme is market countdown. We got the elections coming up. But before we get into any of the details, let's just take a look at kind of what we did this past week and kind of where the market seemed to want to go, and then we'll take a look at the charts. So if we look at the week, let's just get this up on the screen here for you guys. You can see here that on the upper left-hand corner, pretty much all the indexes were either in the red or basically flat. The worst performer this week in the U.S. markets was Nasdaq, down 1.06%. You can see year to date, both the S&P and the Nasdaq are still in the green. 7.26 for S&P, Nasdaq a whopping 28.71%, but that shouldn't be surprising. But the Russell has been made this stealth move, being down about 16-17% for the year and moved up to just slightly below break even for the year. And if you look over on the right hand side, you'll see the trailing PE ratio still at 38.25, the forward PE ratio 25.55. And even though it's about 33% lower than the trailing PE ratio, it is still awfully high. Primary reason, if you look down a little bit lower, you'll see the 10-year Treasury yield close the week at about 84 basis points. And you'll see the S&P dividend yield at 1.73%. And you'll see the spread about 88 basis points between the two. So that still channels money into the U.S. markets. You'll see current volatility finish the week at 27.55. The prior week it finished at 27.41. So for all practical purposes, it wasn't down 9.5%. It was pretty much flat for the week, really. If you look at the sector performers for this week, looking on the left-hand side of the screen, you can see the best performer was utilities, coming in the green about 1.3%. The worst performer was the consumer staples, XLP, coming in the red about 1.23%. You look at the sector performances for the year so far, you can see technology is leading the way, which is, kind of indicative of, because you can see the Nasdaq up 28.7%. So technology, XLK sector up 30.52% for the year. Energy coming in really horribly low at a 46.73%. And then looking in the lower left-hand corner, you can see the world index performance of some of the primary markets. Of course, you can see the only markets that finished in the green this week was the Nikkei, pretty much flat. And then Hang Seng finished in a strong 2.18%. But if you look at over on the right-hand side, year to date, the only one in the green for the year as we go into Q4 is China, coming in at 7.47%. But if you look at the FTSE, which is Great Britain, the index, the London markets, you can see year to date, they're still in a bear market. They got the Brexit vote coming up. They got to determine how they're going to exit from the European Union. We'll see how that goes. It's kind of like on again, off again. And then you can see the other performers, the CAC 40 Paris, really not doing good. Hang Seng, which is a Hong Kong index, down 11.6. So really, year to date, the only indexes that are in the green, really big markets, are the S&P, Nasdaq, and China. And that would be the Shanghai index, which is our version of the Dow, the larger companies in China. Outside of that, fairly steady week, volatility maintaining high levels. Let's just kind of break out the week. We'll just do it in a form of Markley sound bites, right? So the market index performance, as I just mentioned, the markets kind of ended mixed, right? You'll see weakness in some of the technology like Apple, some of the others, technology heavy Nasdaq, kind of just dragged the performance level there, the markets. We did see small cap, even though they were flat for the week, making that stealth move. We'll take a look at the charts here in a minute on the small cap. And then, of course, if we look at market risk versus market reward, somebody's really entirely wrong about this market outlook. On one side, Barron's did a recent poll over the past 45 days, 60 days, and they were asking institutional investors where they were, bullish, bearish, neutral. Most of them are bullish equities, which implies really that they believe the current market price is about right, and they're looking at little downside risk, and they see earnings growth in 2021. Okay, that's where they are. So they're seeing the markets as bullish. Yet on the other side, the option market, most investors there believe that the risk is still fairly high, as evidenced by the current VIX reading of around 27.5. Okay, that VIX reading implies an annual move of 27, 28% up or down. That's a big move. That's bigger risk than where we should be near the all-time highs. Okay, so you've got one market that's implying a lot of risk, and you got another market where everybody just the most institutional investors want to be long. So you may be asking yourself, why is the risk out of whack? Someone will be wrong. We're going to know fairly quickly. With the elections coming up, I think I've seen some skew shifts that I haven't seen in a long time in the futures market and volatility. And just looking out into the early summer months of next year. And I know all of this is related to the election and that skew shift. But someone's going to be wrong. Someone's going to be right. Okay. Now, if we look at the Q3 earnings as they've come in so far, really got into full swing over the past week and a half or so. We've had about 91 companies report their earnings or scheduled report in the coming week. We've had about 135 companies report so far. And according to FactSet, 84% have beaten their earnings estimate. That's way higher than average. Okay. In fact, that's the best beat rate since FactSet started tracking this data in 2008. So that's why the institutional investors are saying, hey, and by the way, our earnings estimates have been revised up for Q4 and then going into 2021. So that's why you're seeing this fight now, this push-pull between the volatility markets, volatility saying, hey, we're going to price in a big price move. It's kind of like one of these binary moves where we can either get a big move up over the next 4 or 5 months or a big move down over the next 3 months or so. And that's as evidenced by we see in the backwardation in the futures, the volatility futures market. So that's a little bit about, excuse me, where we're sitting right now and what I'm seeing in the earnings. How about the economic data this past week? Well, housing starts, excuse me, guys. Housing starts in September. They missed their expectations, but single family construction and overall building permits still reached a 13-year high. So existing home sales really surprised to the upside, jumping almost 9.5% last month. It's the highest it's been since 2006, which really shouldn't be surprising given the average mortgage rate came in under 3%. Now, the other thing I saw last week, weekly jobless claims finally broke a streak of negative surprises and falling more than expected. It came in last week at 787,000. It's the lowest level since March, guys. That was when we had the all-time lows in this pandemic, March 23rd. And continuing claims also continue to fall sharply. It was revised from 9.4 million down to 8.4 million, much better than expected. So we're getting some positive news on the home front. With unemployment data, we're getting positive earnings revisions. We're getting huge beat rates. So it's no wonder that if you just poll the institutional investors, they're basically betting on long side play here over the next 6 to 8 months. In fact, in my charts, I will show you guys where we can run up to 3,800 in the S&P. But by the same token, we also got to honor the volatility market and the options market, which is also very smart. That's how options are priced. And right now, they got a lot of rich premium in the options market, although I've been seeing the call premium come out. Going all the way out to summer of next year. They're leaving the premiums in the skew on the call side with the at the monies, but the minute you move out 20, 30, 40 delta, going out to 4 or 5 delta in the call side, the premium is just being sucked out really big time. I'm seeing that. And that's just causing some strange skew shifts in the volatility curve. But VIX is still very high. So we're going to get some rapid transitions here probably over the next 2 or 3 weeks. So stand by. U.S. Treasuries. Well, near-term hopes of a stimulus deal is keeping Treasury yields up most of the week. In fact, the yield on the 10-year benchmark treasury. Remember, that is considered the world, not the US, but the world standard for a risk-free return. And it's at the highest level it's been since June 9th. It came in at around 87 basis points, roughly. Okay. And then the countervailing force to that continued rise in the 10-year or the Feds, where they're likely to maintain their near zero short-term interest rate target because they want to get that inflation up. Okay. And they're maintaining that zero rate inflation target out to what, 2023? So as a reminder, they're buying 80 billion of treasuries every month, and they're buying 40 billion of mortgage-backed securities every month. That's keeping the short side of the yield curve lower, interest rates lower. That in turn is steepening the yield curve, which banks like. In fact, the yield curve has steepened to about 70 basis points, which is the most that we've seen in the yield curve since 2018. Okay. And then just going across the pond and looking at Europe, everything is shutting down in Europe. All right. European shares are down, as I showed you. All of them this week were in the red. No one really finished in the green this week. The DAX, the German index, finished down over 2% for the week. Year to date, it's moved down to almost 5% below break even for the year across Europe. And with that coming down, the German 10-year Bund, it continued to inch up a little bit, meaning their interest rates moved up. Remember, they're very negative right now, but they inched up on hopes of more U.S. government stimulus, right? Because they all follow the 10-year. Some move at a more rapid rate than the U.S. 10-year, but they follow it. Remember, for our members, we spend more time on interest rates, the credit market, and bonds because they drive the equity markets, not the other way around. Always remember that. Money flow drives the equity market. Equities don't drive the price of bonds and the resulting interest rates and the currencies. It's completely the opposite. The bond market reflects the bias and the opinion of the big money, and it's a lot bigger than the equity markets globally, and that in turn affects interest rates, which affects currencies, which then drives and points to where the money is going to flow in the equity market and how much of it. All right. So just remember that. For our members, we spend more time on it than usual and just kind of where the markets are going. Okay. So across Europe, we're seeing a great tightening. A lot of countries are tightening their mobility restrictions due to the rising case of coronavirus infections. Ireland just announced a 6-week full lockdown. France extended their curfew to cover about 70% of its population. And they said their state of emergency could extend all the way out to February 2021. So it's no reason to doubt why the European markets are just not faring well right now. Okay. And all of this kind of spurred the ECB central bank president, that would be Christine Queen Bee Lagarde, to come out and basically say that the European recovery risked losing momentum as countries impose new restrictions. I happen to believe you should not shut things down. Let them run, and you can, institute wearing masks and things like that if you have to, but I just think it's gotten out of hand. And it doesn't surprise me that over in the European theater, more countries are shutting down. And if you look at the U.S. markets, those states that are more heavily Democratic controlled have more shutdowns and a higher degree of number of deaths and mortality from COVID than the Republican states. Most Republican states now are open or opening up fully. I'm down here in Florida, and you never know there was a COVID crisis outside of seeing people walking around in masks, depending on the establishment that you walk into. And I think people are smart enough to manage themselves. If they've got underlying conditions and they're smart, they're not going to be running around and going to bars and doing that. If not, then it is what it is. But I think when the government starts to force these shutdowns like they've done in New York and some of these other big cities, they're just going to destroy everything. But anyway, that's my 2 cents. What I want to do is just show you a chart. I usually cover these types of charts in our weekly market watch for our members only, but I'll just include a couple of them here just to show you guys some of the things that we do. And it's really good. They help call a lot of things for us. Now, I share these charts with our members. I'm looking at this one chart here. I'm going to give it a second to come up on the screen, but it is a breadth chart. Okay. Markets are defined by market breadth. How many companies that are listed are participating in the up move and the down move. And as you can see here, I'm using the McClellan Summation Index. I've got my own proprietary EMAs and things on here, but you can see in the red is when we got short. You can see here, August 19th, I was getting people short, even though we moved up a little bit. You can see the backdrop is the S&P, but then we had that big drawdown. Now, I was forecasting a drawdown, to be perfectly clear, the end of July and sometime early August. But you can see here, starting in July, we never really got the breadth indicator. This is a short-term breadth indicator. I also have a medium and a long-term, and we combined all these. But you can see here, we never really fell below. The black line never fell below the red line. Or purple line. So we really didn't have us getting short until about the third week in August. And then the markets had that final blow off top into September, and then it just gave it all up. We fell almost 10%. Some indexes fell 10%, and you can see the breadth. I colored it in red. And just interesting note, you can see right here in red, the markets we got. Let me just get that down like this. You can see here we got the first indication of trouble here on June 22nd, and you can see the markets kind of came down, the breadth indicated back up, and the real big move lower here coming into March. You can see the breadth indicator gave us a down move short term January 23rd, and then it went flat right here, but it never really rose back up. I should probably just color that red. So really January 23rd. Now we know when the breadth indicator gives you, based on my signals and what I've got on the chart, a time to be very careful on the near term. You honor it, okay? You want to honor it. You never know if that next downdraft is going to be a killer or it's just going to be normal. Well, obviously the downdraft really started to happen. Let me just get this on the screen here. That downdraft started to happen on February 21st, and then away we went, right? But looking at the charts here, it had our members all set and ready to go. And then I was getting our members long in late March, early April, and I published a list to our members of about 10 stocks. Now, every one of them are up dramatically, but there's 3 or 4 that are doubles and triples. And if you'd done options on them like we did on a few, or futures on some of the commodities, it would have been a home run. So, but you could see here where everything shifted back to the upside here in late March, early April, and then we just had a good run up, right? And then we had a momentary blip here in May, and then just moving forward in time. And I highlight this in red so that you can see when we're in red, what's the condition of the S&P when we entered the red condition and when we exited the red condition. And if it exits higher than where we entered, usually it's not that much higher. It's almost flatline, but you can almost be assured of a down move, right? And then, of course, we have this one right here where it went red on August 19th, and we were actually, the S&P was at 33.75, and the S&P ran up to 35.80. All right, so that's almost 200 points higher, and yet it stayed in the red. That told me now, and we used other charts for our members that we use to start to look at longer term signals to see what we want to be. This was saying that this is the traditional blow off top before about a 10% correction, roughly, because you get that big spike up, even though the markets are saying, okay, less and less breadth is participating in this move. And you can see down here, this is an oscillator chart, but I affectionately call it an oscillator when it goes into the red and an oscillator when it was in the green. And then we got an all clear signal right here around October the 4th or 5th. And then you can see a move up. We came back down here, even though the markets moved lower like this, you can see we never went below the line again. So we're now back up. So we're still back into the green. We dipped briefly in the red in the oscillator, which became an oscillator, but we never did short-term signal. You might want to lighten up on this. It's still remaining bullish at this time. Okay. Now all things can change very quickly, but that's a little bit about how this chart works. The other thing that we pay attention to from a market, and there are others on here, but you can see here for our weekly market watch, we look at I've got about 8 breadth indicator charts. We look at volatility. We look at asset correlations. All right, to just kind of look at where money is running. We use it heavily to determine whether we're going to play silver or gold or copper. We used it to get into copper early, made some great money on that. People are still long copper. It's a great run. Bonds and interest rates, we do this to track the yield curve. So for instance, if we look at the yield curve right here, you can see in this particular case, this shows the German 10-year Bund down at almost 58 basis points below zero. There's the zero line. And the black line is the US interest rates. And then you can see Great Britain, Japan, and Germany. And if you look at it, and if I were to just draw a line on this chart here, we're starting to see a divergence between us and Europe, and it's going to snap back. It always does. But if we look at this, and I just draw a line just like this, right in early June, okay, you can see the US rates are going like that. Great Britain's going up just a little bit. Japan is kind of flat, but look at Germany. It's going just like that. So, and it's coming down to the lows that it made in March 23rd. I mean, that's where it's going. All right. So this, and the German Bund, they call it the Bund instead of the bond, at 58 basis points below zero. That's a little bit more than 0.5%, 58/100% below zero. Generally, what that does is it forces money out of big hedge funds and firms that are investing. Now, by some of their bylaws requires them to invest in currencies in country as well as elsewhere. But when you get Germany and Japan that low, it moves money into the U.S. markets. Okay. Now there's going to be some great trades in this when this reverses. And when this reverses, you're going to see the German markets move up like that. And a lot of this money is going to leave our shores and come back into Germany and other places in Europe. There's going to be some great opportunities, but we're not there yet. For our members in our weekly market watch, we cover this stuff. It's so important to understand, so important to play, because you just have to watch it. And then, of course, if we look at the yield curve, this is the 3s over 10. This would be the 90-day yield curve over the 10-year Treasury. And look at it. I mean, it's really up pretty good. Right, we were in the red here for quite some time, but the yield curve has moved off a negative 52 basis points to finishing the week at about 75 basis points in the green. We haven't been this high going all the way back to 2018, right around October of 2018. So that's a long time for this yield curve to be moving up like that. Okay, and then you can see down here I've got plotted the markets. So as that yield curve goes higher, it's going to help out the banks and financial institutions because of the way they borrow and lend money, and they're basically playing the net interest margin between the two. But this yield curve here is clearly supported by the Feds, because as I said, they're buying 80 billion of treasuries every month, 40 billion of mortgage-backed securities every month. And they can control what they buy, whether they're buying on the back end of the yield curve or the front end. And right now they're buying on the front end because they've committed to keeping interest rates 0 to 25 basis points, for the next couple of years. So by buying on the front end, they leave the back end alone, and the back end, which is bonds, is moving higher. So it creates a wider yield between the back end of the yield curve, meaning the 30-year or 10-year, and the front end, meaning the 3-month or the 2-year or the 5-year or the 10-year. That's good for banks. All right. Now, what I want to show you here is, let me just switch the screen. These are just some of the charts that we go through for our weekly market watch. So we've got a lot of deals running. We get a lot of folks coming into our group. They always seem to come in after we get through the summer into the end of the year. So look forward to having you guys come on in and join us up. Let me just switch over and just take a look at the charts here for a second. Let's come over here and we're going to look at the Russell. All right, remember I told you the Russell's doing really well, so I'm going to let it wait, paint the screen for you guys, and then when it gets up there, we'll rock and roll. Now look at the Russell here. We've got a 3-4-5 Elliott wave pattern, all right, but there is no divergence in the MACDs. Traditionally, when you hit an Elliott wave 5, you want to see divergence in the MACD to the downside. That would suggest a further pullback in like an ABC or a zigzag kind of pattern before moving higher or lower. In this case, there is none. That means any dips here are going to be very light and will probably come back up. 1668.46 roughly is the closing price of 2019. So if we move up above that level, we're going to be in the high we're going to be in the green for the year for the Russell. And then the 2020 high before the pandemic, we actually made it up to 1715. And then the all-time high for the Russell was last seen in 2018 in September at 1742. If we get the sun and the moon and the stars that line up, right? We get a vaccine coming out, we get stimulus, guys, you want to be long the Russell. And what I would recommend is you want to look at TNA, Tango November Apple. TNA is a 3x small cap bull. Do not hold it for a long period of time, but it will run and it will move very quickly once some of these things happen. All right. And that would be just a nice one to play, a nice one to move in on. Now, the SPX 3X bull is another one right here, but TNA would actually move quicker, all right, because the small cap relative to everything else would be moving pretty good. All right. So that's kind of what I'm looking at there. Of course, if we look at the Dow, let me just find the, where are we? Here we go. Here's the Dow Futures. You can see here, the 2019 close, we were in the green for the year, then we're back in the red, we're in the green, we're back in the red, but notice we made a lower high. So this could be a signal that are we going to be able to make a higher high or not in this near term? We did have all-time highs this year in the Dow, okay? And in the E-minis, if we switch over to the E-minis, you will see we had all-time highs in the E-mini as well. Right now on the E-minis, I've got a forecasted near-term target of about 35.76. Longer term, for our members, we'll review that in our weekly market watch this Sunday evening. I'm projecting 37 to 3,800. But we've got huge support down around the opening price of the year, which would put us flat right around 32.36. But there's another big area of support at 3,400. So just remember this level here, guys. 3,400 is a level that should it not hold up, then we're going to come down and see the 50 EMA very quickly and then quickly drop from there. So our R levels and S levels that I talk about with our group, our S1 level, which is just short term, is about 3440, but our S2 level is sitting right around 3400, give or take a few points. And then our R level up above is, right around 3,500. So if we knocked it out and just said, let's look at it, 35 to 3,400, that's the range that I'm looking at right now. We're going to break one of them. I can't tell you which one. Right now, the charts and the momentum would indicate we're going to move up higher. Okay. In fact, we're going to move up, take out this prior pivot high, and challenge our all-time highs. Okay. That's what the charts are indicating. And we just got to follow this and just kind of see where we're going to run. Now, if we come down and look at volatility and we look at the VIX, you can see here we're still extremely elevated. Typically, when you get the S&P near all-time highs like we are, you do not have a VIX at 28. You just don't. The VIX should be down around 14 or 15, okay? And the fact that it's elevated like this tells me that there's a lot of risk out in the market according to volatility. If you look at the annualized movement and how volatility works, the close at 27.55 means there is the markets are pricing in about a 67% probability that price 12 months from now is going to be either 27.55% higher or 27.55% lower, that range. So that gives you the outside boundary, and that's just one standard deviation. Markets typically always move more than is forecast. You can get a 2 or 3 standard deviation move, or a 4 or 5 standard deviation move, or even greater like we had in March. This is just one standard deviation. So the markets have priced in some extra premium near term. We got that backwardation in the yield curve. If I look at the November, December, this is the back month. Notice we're in the red right now. That means we're in a backwardation mode. This compares the November volatility futures to the December volatility futures. We're in the red here. Now, just a few weeks ago, back in early September, you can see we were in a much more egregious backwardation, and it's come back down to a little bit more normalized level. And then if we look at December and January, remember this one that we're looking at here is November and December. Let's compare December and January. If you look at December and January, we're in the red here too. In fact, we're in a backwardation going out all the way out to May and June. And then after that, it goes back into a normal contango term structure. So we've got a really screwed up skew. I haven't seen this. I don't think I've seen this in a long, long time. This far out in time. In fact, I don't know if I've ever seen it. And we've got the elections coming up. So that means the markets are it's just a countdown. The clock is ticking, tick tock, tick tock. And we're going to find out where the markets want to go very soon. If we look at the bond markets, we've seen interest rates basically edging up, right? I showed you the treasuries. Let's look at the 10-year. All right, if we look at the 10-year interest rate, look at this. We've broken out. We held the 50 EMA. We broke out of this range that we've been in for a while, and we moved up. We're over 80 basis points. Look at the range here. We're now in this new range up to 95 basis points. You can see this. We've broken out, we moved up. By the same token, the bond market has moved down. Now, this is the 30-year bond, okay? So further out on the curve, look at the bonds. It's taken out its 200 EMA, and it's come down. I was telling our members that we can expect the bond market to start rolling lower back over here in early October. And it rolled over really a little bit faster than I thought. It came down and fine support at the 200 EMA, but it could not broach the 50, and that was the first clue to come back in and short the bond market, okay? And that just means interest rates are moving higher. So that's kind of what I'm seeing here. But this is on the back end of the curve. This is why the yield curve is getting steeper and steeper. Okay. And there's no divergences in here. There's no bullish divergences that would suggest at this point in time that interest rates are going to reverse course here. We're going to see after the election everything start to settle up. Okay. I mean, everything's going to settle up, and we're going to see. If we look at the US dollar, it's coming down to my target down here of about 91.18. That is the target. We got a 3-4 and then a 5 leg, which would mean if we hit my target, then we're going to break out below the 2020 low that we made back here in September. All right. Now, if we have a big move lower, you're going to see money rush into the dollar, right? It tends to be a flight to safety issue. But short of that, longer term, folks, the dollar is going to go lower. And look at across Europe, when the German Bund starts running higher and they start getting rid of that lockdown, and it could be just as simple as the vaccine. They've now got a vaccine that's approved, a prophylactic that you take to prevent you from getting to the disease. That means they'll start reinvestigating and looking at opening the country sooner. The markets aren't going to wait. They're going to start moving right away. That very day that the news line hit prints, and as soon as it prints and hits the streets and the newsstands, you're going to see the euro go stronger. You're going to see the boons move up. You're going to see our dollar come down and the euro gets stronger. And if we look at the euro, and I've said this many times, you want to be favoring the long side of the euro. We're going to come up, probably make new highs up here, okay? And if we look at this, I've got a longer term euro projection way up here on the weekly of 1.26. But if we look at the short term projections, I'm looking at it coming up to about 120 again, making new all-time or new 2020 highs, right? Which is kind of near where we close for the year. So if we get near the 120, it'll be flat for the year, but we'll see what happens. Now, the one fly in the ointment of a stronger euro is the Brexit. If they have trouble and they have a hard Brexit, that could punish not only the pound, but it could also punish the euro as well, which should be bullish for the dollar, because the dollar really is not the dollar. It's more a dollar index, and the euro represents about 57.6% of the dollar index, roughly. So that's kind of where we're sitting right now. If we look at the yen, which you can trade, remember the yen, when the markets get scary, the yen goes higher and the Nikkei goes lower. And you can see here the yen has just slowly been moving higher since the summer months. So we're getting a lot of cross currents in the markets right now. A couple of primary reasons: you get a lot of hedging going on, but you've also got the situation where you've got a lot of fiscal stimulus, and you've got governments like our Fed, like the BOJ, Bank of Japan, like the ECB over in Europe and China. They do it a little bit different there, but kind of similar, where they're just pumping a lot of money into the economy. They're keeping the interest rates low or below zero to induce inflation. And that screws up the currency market a little bit. But left to its own druthers, we got to be careful here because we're seeing a lot of cross currents. If you're really unsure of what you want to do, then you may want to just sit on the sidelines until after the election. Because right now the volatility, it could just come sucking out because we're up around 28 VIX right now. It could all suck out if the markets get what they want, or it could stay elevated. It just depends, right? Now, for our members this Sunday, we'll go through a Trump win versus a Biden win, versus a Biden win and the Democrats take the Senate versus a Trump win and the Republicans keep the Senate. We'll look at a couple of different scenarios. Okay. The primary view of these is having to do with stimulus. Okay. Now, if you look at the metals market, you'll see we were all in on copper. I was all in. Everything that I had indicated copper is going to go to the moon, right? And we got in early April. Now we had some members get into the copper futures, folks. That's a huge move in copper futures since early April. That's big money, right? All you needed was just one copper futures contract. We have several members that did more than that. What we did, if you couldn't trade copper futures, of course, just trade Freeport-McMoRan. And if we look at Freeport-McMoRan, which is Foxtrot Charlie X-ray, you'll see here again. This was one of the ones on our list. I said, you got to jump in, guys. You're not going to get an opportunity like this again in a while. It was around $6.30, $6.40. Closed out the week at $18.36. So it's almost a triple. Not quite, but pretty darn close. You can see that trend line. And we were long a combination of stock and options and just playing both of them against each other. You know, to hedge downside, you can see the red line is the 50 EMA moving up almost with the trend line. Right? And every time it's come down and touched the trend line, it would hold below it for a day or two, but it always stayed above the 50 EMA, right? It always held that 50 EMA. And it's just been a great trade. There are several other trades that we took that we stayed in, that we're going to continue playing to the long side. And of course, if we look at the gold market, you can see here gold is running sideways. Now, I saw some articles and some pundits saying gold is going to be over 2,500 by Christmas. All right, by the end of the year. I'll have to believe it to see it, or I got to see it to believe it. I don't know the best way to say that. But my chart here and my upside prediction is sitting right around 2180, 2200, okay, going out in time. But we're having probably an extended Elliott four wave kind of move. It could be the four waves can be just really strange. But if we can get back up above the 1990 level, then I think gold will be worth a look. Same thing with silver. If you look at the silver market, it's had a huge drop off. But if you look at the silver projections, I'm looking at silver up around 34. It's sitting at 24 right now. Again, an Elliott wave 4 drawn out. It could be very choppy, very long, but I'm looking for these to move higher as well. Okay. Then, of course, if there's always oil, oil is just having a very bad year. Here's my long-term support level here around $35 a barrel. And it's just, you know, it's really hard to trade now. A lot of the brokerage firms, interactive brokers, thinkorswim, they're just not letting you do some of the things in the option market that you could have done before oil went below the zero rate. All right, just wouldn't let you do it. So we're really the only way to trade oil now is trade some of the majors or trade some of the ETFs like XLE or some of the others. And if we look at XLE, you can see just how ugly it is. It's just been, you know, we traded XLE. That was one of the 10 items that I wanted to go long in, one of the 10 asset classes that I said go long in off the March 23rd low. Now, you could have damn near gone long just about anything, but there were some that accelerated better than others. Oil was one of them, and I had us long this one too. And then as it started rolling over, we started hedging our profits. And then as it kept going lower, we just got out, took our profits, and said, thank you very much. And then oil just, it could not really regain and hold the 50 EMA. And here we are sitting right here, right now. I think it's going to run sideways in a contrarian kind of way. I wouldn't mind dipping my toe in the water in a long oil right now via XLE. You do not want to trade USO. It's a broken ETF. Don't even touch it. The way they calculate it and do the roll yield, you'll be punished long term in USO. Ever since they did that reverse split when oil went below zero, it's just broken. Don't play it, in my estimation. So a better way to do it is do like a basket of energy stocks. One of the better energy companies is Chevron. They have a better balance sheet than Exxon. So you could just say, you know what, if you want to get some some dividend income, come in here and you could pick up Chevron, right? By selling puts underneath, you can see the March 23rd low. That can be, in my mind, the solid floor. And just do some deep in the money calls, sell some out of the money calls against it, or maybe combine it with stock to collect some dividends and make some plays there in that one. That's how I would do it. Now, nat gas has been interesting. Nat gas had this huge move lower. I was expecting a higher high, as you guys heard me say. We did get that higher high right over here. But notice here on this higher high, there is no divergence in the MACD. So that just said this was a strong, valid move. So now what I'm looking for is a pullback. And then let's make another higher high. And on that second higher high, or the third one, if you're counting back over here, that's the one we're going to want to go short. That's the one we're going to want to play. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and join us. We're going to get some great opportunities coming up here post-election. And we got to let it play itself out and let the big money start to make their bets or confirm their bets and add on to their bets, and then we're going to follow. And it's as simple as that. All right, everybody, have a really great weekend. And members, I'll see you this Sunday night, 8 p.m. for our weekly market watch. Take care, folks. Ciao now.